Very happy to welcome you all. And as some of you may know, the mission of CEFA is to bridge the gap between the economics and finance sector and the professional business life. And we think welcoming you, Ardal, and your hedge fund today is a great opportunity to cover that. And we want to thank Christian for making this possible as well. And I want to thank the team at CEFA for putting in the work of doing the marketing and so on for this event. So yeah, enjoy it, and hopefully also see some of you tomorrow at the Nicolai Tangen event, which we're very excited for. So yeah, welcome, Ardal.
Thank you. So I'm the warm-up act for Nicolai Tangen tomorrow. Big shoes to fill. So again, I'd just like to say thank you for the kind introduction. Thank you for Christian for inviting me here to speak to you all today. I'd probably start off by saying congratulations for being here at such a well-renowned institution. I know it's not easy to get into a place like this, and these sort of opportunities to meet people like me or people like Nicolai especially is pretty exceptional, so I'd encourage you to make the most of that. My talk today is probably quite an unusual title, How Not to Start a Successful Hedge Fund. And I think the reason why it's titled like that might become a little bit clearer if I explain to you that it's actually because of a mental model that's known as inversion. So if you look at the screen here, just with a rough show of hands, the gentleman with the blue tie, who knows who that is? So everybody here, so that's great. So we all know, so that's Warren Buffett, the world's most successful investor. And then what about the gentleman to his left with the red tie? So there's a few less people, but most people know. So that's Charlie Munger. So Charlie Munger was Warren Buffett's right-hand man for almost 60 years. And he pioneered or made popular this idea of inversion. So inversion itself is a Stoic philosophy, and it was explored in the writings of Marcus Aurelius, who lived from 120 to 180 AD. And he was a warrior, so obviously the things that he said were more pertinent to his time. But he essentially posed the question that instead of thinking about how to win on the battlefield, he said, why don't we think about the opposite, how to avoid losing? And that's one of the things that Munger pioneered. And my speech today is sort of in honor of that, which is why I flipped the question on its head as to how to be successful is the opposite, how to not be successful. So Munger actually gave a speech to the commencement class of Harvard University, and the speech was quite hilariously titled, How to Guarantee a Life of Misery. So you can imagine the sort of things involved with that. But he basically said, he says here, which you can read behind me, invert, always invert. Turn a situation or problem upside down. Look at it backwards. What happens if all of our plans go wrong? Instead of looking for success, make a list of how to fail. Instead, through sloth, envy, resentment, self-pity, entitlement, all the mental habits of self-defeat, avoid these qualities and you too will be successful. And I think that that's just a very interesting way of thinking. So before we start, probably I'd like to just explain to you a little bit more about who I am and the firm that I represent. So my name is Ardal Loh-Gronager, and I run a hedge fund, which we call an investment partnership that we started in 2021. I'm responsible for all of the investment decisions at our global fund. And I'm also the author of a book called The Perceptive Investor, which I hope you don't mind if I plug for about 30 seconds. We have about an hour together today. So for the first half, I'll be giving my presentation. And for the second half, which is the part I'm most looking forward to as well, we'll be doing the Q&A. So I'm going to gift a signed copy of this book to whoever asks me the most challenging question, which hopefully raises the bar on the level of questions that are going to be asked. As background for myself, jeg er helt dansk or helt engelsk, and that's all the Danish you're going to get from me today, because we have an international crowd. I consider myself very international as well. I went to 8 different schools and lived in 6 different countries growing up before I studied accounting and finance at Durham University in the UK. I've got over 10 years experience in financial services on both the buy side and the sell side. My career started with internships at Swiss Re Asset Management and Goldman Sachs. From there I moved to be an interest rate trader at Morgan Stanley, learning the macroeconomic side of the business. From there I moved to be a credit trader at Credit Suisse, which is learning the microeconomic side of the business. From there I moved to be the chief investment officer for a UK-based family office, which is essentially where I came up with the investment strategy that we run here today at Loh-Gronager Partners. On the side of this, I've always been an entrepreneur and a lover of business. So I started my first business when I was 7 years old in the school playground, trading computer games with my friends. And from then on, throughout my career, I've always started businesses on the side. And I think that's what I think is at the heart of the presentation today, that if you want to be successful, you have to be an entrepreneur. So if you don't want to be successful, you need to do the polar opposite of everything that I'm going to say. So Loh-Gronager Partners is an investment partnership, and we established it based on the principles of the original Buffett partnerships, established by Warren Buffett, whose picture I showed you earlier, from the 1950s and 60s. So one of the things that's not very well known is that both Warren and Charlie both ran hedge funds before they started Berkshire Hathaway, and they had exceptional track records. How we invest is we're concentrated long-term value investors, and we look to invest in exceptional businesses. We have a global portfolio of roughly 30 equities in our fund, and despite how diverse a range of businesses they all have several things in common. Namely, they have strong growth potential, they have widening economic moats, and what I think particularly important is they're run by high-integrity management that think like we do as long-term business owners. So sometimes I get asked, what is a hedge fund manager? What do they do? It's usually my mother that asks that question. And I often think that a picture is worth 1,000 words. So what I put up here is one of my favorite paintings, which is by the Belgian artist René Magritte. It's called La Clairvoyance. And what you can see is the artist there is pictured seated, and he's looking at a stationary egg. And yet what he's painting on the canvas is a fully grown bird in flight. So what he's demonstrating there is perception, which coincidentally is also on the title of the book. But perception, I think, is what marks out the exceptional investors from the rest. It's the ability to look at all the currently available public information and project forward a different conclusion or a different future. For those of you that are not completely familiar with the hedge fund industry, I think it's worth just spending a couple of minutes discussing it. So what is a hedge fund? I think that's a question that I also get asked often, usually my father this time as opposed to my mother. So the term is usually referred to Alfred Winslow Jones, as widely recognized as the first ever hedge fund manager back in 1949. And he launched what was known as a hedged fund, which meant that he went long a basket of stocks that he thought were going to go up in value, and against that he went short or sold a basket of stocks that he thought would go down in value, and hence it was a hedged product. Since then, that term has come to encompass pretty much anything and everything when it comes to an investment strategy, but all of them have the same structure, which you can see at the bottom of the slide. Essentially, it's a group of investors that pool their assets together. They hire a fund manager who manages that pool of assets and invests it into a portfolio of stocks, bonds, options, swaps, or pretty much anything by general definition that is listed or liquid would probably be the normal definition of what goes into a hedge fund. And he does that with the objective of achieving a specified rate of return that the investors are looking for. What's the business model for a hedge fund? Well, it's typically known as the 2 and 20 model. So the manager charges a 2% management fee of any assets under management, and then against that he also charges a 20% performance fee on any assets, on any returns generated on those assets. So if you think about it quite simplistically, if you've got a $100 million hedge fund, the manager gets $2 million on the 1st of January every year for not necessarily having done any work. On the flip side of it, let's say that manager makes a 10% return, so he generates $10 million of performance, he clips a 20% performance fee on that $10 million, so he makes an additional $2 million at the end of the year. So what you can see there is already the skewed incentives of the business model, where the manager gets paid the same amount of money for not doing any work as he does for generating performance. And how does the industry look? Well, you can see here that there's an absolute plethora of different sort of investment strategies that come under the hedge fund umbrella. Generally speaking, there are about 10,000 hedge funds globally, and they manage about $4 trillion of assets. But the thing that I think is most interesting is what I put in this bubble here on the bottom, which says the average lifespan of a hedge fund is only 4 years. So what that tells me is that a lot of these other hedge fund managers have already got a copy of my presentation about how not to run a hedge fund. So with that, we're going to answer the question, how not to start a successful hedge fund. And I think there are 5 rules. The first rule is don't be an entrepreneur. To not succeed as a hedge fund manager, you must not be a good investor, and you must also not be a good businessman. You mustn't have a passion for business. You mustn't enjoy running businesses, founding businesses, running businesses, hiring teams, or indeed any general interest in business itself. If you were going to start a business, you want to make sure it was totally undifferentiated from all the others. Exactly the same product, exactly the same offering as the other 10,000 hedge funds that are already in the industry. You also want to be a bad salesperson. You want to be able to be poor at communicating what your investment strategy is, enforcing the point that your fund is exactly the same as everybody else. And finally, when you do find those investors that want to give you money, you want to do your best to discourage them from doing that. You want to make sure that you're telling a bad story. You want to make sure that they are short-term orientated and that they really don't understand what you're doing. Rule number 2, don't establish your hedge fund with strong values. Partnership. Don't have a partnership mentality in everything that you do. Don't try and foster a collaborative environment for you and your team and your investors. Focus. Don't believe that through dedication and passion that consistent success can be achieved. Excellence. Don't aspire to excellence in everything that you do. Don't constantly strive to outperform. Try to be average and generate subpar returns. Reputation. Ignore what Warren Buffett said, that reputations take a lifetime to earn and only moments to lose, and be an unreliable partner. Honesty. Don't make intellectual honesty a core part of both your business philosophy and your investment philosophy. And finally, integrity. Don't hold yourself to the very highest personal and professional standards. Always under-promise and under-deliver. Rule 3, which I think is probably the third most important rule. Don't try to beat the market. I think historically hedge funds in general have already managed to do or understand this point relatively well, whereby what we show here on the chart is the cumulative returns for the hedge fund industry during the last 20 or so years. So it's from 2000 to 2021. And what you can see from the bars is that although the assets of the industry have increased during that period of time from just under $500 billion to over $4 trillion today, the cumulative return for all the hedge funds in the industry has averaged about 5.2% per year. So they're hardly shooting the lights out, especially if you can compare that to the S&P 500 at just under 8%, or a very conservative measure of risk, which would be the Bloomberg Barclays US Aggregate Bond Index at just under 5%. So what that tells me then is that you could earn substantially better returns or take significantly less risk by ignoring the hedge fund category entirely. So how do we achieve that? How do we make sure that we don't beat the market as a fund manager? Well, the first thing we want to do is we want to make sure that as the new fund manager, we put as little of our own money into the fund as possible, because we don't want to risk any of our own capital, given that we know our business will probably only be around for 4 years, hopefully. So on that basis, we're going to get as many investors together, and we're going to use their money, and we're going to make sure that we want to be out of business as quickly as possible. So how do we do that? We choose a benchmark that's hard to beat. So we'll choose something like the S&P 500. Now, to outperform or underperform that index, our holdings are going to have to be very different from the index itself. And we're probably going to employ leverage to magnify those returns. So the best case scenario is we'll have a concentrated portfolio of stocks that will go down very quickly and we'll be out of business in no time. If the inverse happens, where the stocks we choose go up and we significantly outperform the index, unfortunately more investors are going to come and find us and ask us to manage their money. And that's what you can see here, that as we significantly outperform, as time goes by, our fund gets more assets. So what do we do to discourage these people from giving us more money? Well, we want to make sure that our returns decrease and get closer to the benchmark. So we'll change our investment strategy over time to make sure that our portfolio holdings more and more closely come to mirror those of the benchmark. And that's essentially what happens in the hedge fund industry over time. And that's the reason why all the academic literature shows that the smallest and youngest hedge funds produce the greatest returns. The older and more established the hedge fund, the closer the returns are to mirroring the benchmark. Rule number 4, don't have a fair fee structure. So I've mentioned at the introduction that the industry standard model is the 2 and 20. So a 2% management fee on $100 million of AUM, so assets under management, would be $2 million for the manager on the 1st of January every year, not necessarily for having done any work. And then again, with our 20% performance example with the $100 million fund, so they make $10 million, they charge a 20% performance fees, they get another $2 million. So of the $10 million of returns that they've generated for their investors, 40% goes to the manager. So they've generated a 10% return, but the investors are only getting 6%. Doesn't sound like the fairest fee structure to me. It puts the emphasis on asset gathering on the part of the investment manager and essentially takes the focus away from generating significant outperformance, which is fantastic for us as the fund manager, but is not necessarily so good for our investors. And rule number 5, don't treat your investors as your partners. This, I think, is very important, because once we've decided that our investors are no longer our partners, We're going to look to take advantage of them in every way we can. And luckily for the hedge fund industry, there are many ways of doing that. There are many, many different types of hidden fees and costs. One example here are fund costs and expenses. So that's paying for the salaries of employees, paying for office space, paying for travel. And if we include these into the costs and expenses line of a fund, these average roughly 2% per year for a normal hedge fund. So all of a sudden, if we've lost 2% for the management fee, 2% for costs and expenses, another 2% for the performance fee, all of a sudden our investors are getting 4% from the 10% that we've generated that year. And you might think that's bad, but we've got even more hidden costs that we can include here. So there are two more main categories of costs that we can include. So one are trading costs. So these are the costs of buying and selling constantly. These are the costs of paying broker fees and commissions when you're trading. And the second is taxes. So everybody in here is probably like myself, a taxable investor, which essentially means that when I, as your fund manager, buy an asset and it goes up in value and I sell it, I crystallize a gain on which you will be responsible for paying capital gains tax. And depending obviously which country, Denmark probably has quite a high one. So essentially what this leads to, the fact is that the higher the portfolio turnover of the investment manager, in general, the worse off the investors of the fund are. And that's just a general rule of thumb. So for our fund, because we don't want to be successful, we want as high a portfolio turnover as possible. And I think a way just to explain this is, there's a lot of academic research on how this works. And the seminal paper in this space is called, Is Your Alpha Big Enough to Cover Your Taxes? And in this paper, they essentially look at what is the market rate of return, what is the portfolio turnover of the investment manager, and therefore, net of taxes, what do you or I, as the investor in the fund, receive? And what it found was that if we take our example of our fund that makes a 10% return, and let's say they have a 50% annual portfolio turnover ratio, so that sounds quite high, but actually the average in the fund industry is over 100%. So if we have a 50% portfolio turnover ratio, we've actually got to return 4.5 percentage points in addition to the market for you to get the same result. So in this example, if the S&P 500 returns 10%, I, as your fund manager with a 50% portfolio turnover ratio, would on average have to return 14.5% for you to earn exactly the same as what you would have returned from just investing in the index. So what you can see here on the final chart on the right-hand side is essentially that we've now, with taxes, costs and expenses, management fee, performance fee, we've achieved our goal. We've made sure that if we deliver a 10% return for our investors, they receive absolutely zero. So if I was to summarize our business strategy of how not to start a successful hedge fund, I would say, don't challenge convention. Embrace all the major inhibitors of superior hedge fund performance, as well as the most common complaints about hedge funds, which are that they have very high fees, managers don't have enough skin in the game, and they deliver overall poor returns. I'd say don't ensure alignment with your investors. Focus on charging those high fees and generating, at best, average returns, because this will keep the business undifferentiated and make sure that the moat around your fund management business is very, very shallow, that it has no competitive advantage and easily disappears. I would say don't address agency issues head on. Make sure the fund manager has very little skin in the game. They don't invest a lot in the fund at the start, and they don't reinvest any gains that they make back into the fund. And this creates as little alignment as possible with the external investors, and this therefore minimizes trust. And then finally, I'd say don't focus on performance. I'd say the hedge fund's objective should be to constantly match the benchmark, returns of the market, focusing on the shortest possible time horizon to maximize the fee income of the fund manager while he's in the job for the next 4 years. And most importantly, borrowing from Charlie Munger, I would say invert. So here I've inverted what Buffett said to his own investors in his own hedge fund when he started it in 1950. And he said, we can promise you, well, he said, we can't promise you. So obviously I've inverted it here. So I said, we can promise you results, but we cannot guarantee that your financial fortunes will move in lockstep with ours for whatever period of time you elect to be our partners. We have a strong interest in high salaries and any other means that we can find of gaining an edge over you. We want to make money regardless of if our partners do. Moreover, when we do something dumb, we want to be able to ensure that you derive no solace from the fact that our financial suffering is nowhere near as proportional as yours. And with that, I'll say thank you very much for your time. I'm very happy to answer any questions that you might have. a book going, so if there's only one question, then you're guaranteed to get it. Sure.
What is the rationale behind the 4-year period of an average hedge fund manager?
So typically speaking, it means that the average hedge fund manager is only in business for 4 years. And I think it comes down to two things. I think the real reason is that a lot of people think that they're very good investors, which is possible. But by definition, only half the people in this room can be above average. So let that sink in for a second. And I think the separate side of that is what I tried to allude to at the beginning, which is to run a fund, you also have to be an entrepreneur. So I think a lot of people that are good at investing might not also be able to pair that with being a good entrepreneur. And that means being able to run a business. And they're not mutually exclusive. So I think one of the main reasons why hedge funds disappear so quickly is because they might generate good performance. And actually the academic research tends to show that most funds, they don't fail because they don't earn a good enough rate of return. They fail because they can't scale the business. They can't convince investors to manage money, to allow them to manage money on their behalf. They can't meet a quarterly audit. They can't do a letter at a regular interval. They can't run a business. And there's a real passion that comes from running a business. And if you can't force that on somebody, I guess is what I would say. Because if your focus is entirely on investment performance, then you're probably not the right person to manage money for external capital, because those people will call you and ask you questions and say, you were down this quarter, why? And if you don't like justifying your answers, if you don't like talking to other people, then actually managing your own pool of capital is probably the right thing to do. Thank you for your question. Sure.
What's your hedge fund's competitive advantage? So how do you differentiate?
Great question. Almost like I knew one like that might be. So how do we differentiate my fund from the rest? So let's see if I manage to live up to the inversion of everything I've said before. So we don't charge a traditional management fee. So we don't get paid unless we generate performance. So that's the second point there. We charge a performance fee. But we don't charge a flat performance fee. We charge a performance fee above a minimum cumulative hard hurdle rate of return. So there's a minimum return that we need to generate for you on an annualized basis. And when I say it's cumulative and hard, what I essentially mean by that is if we don't meet that minimum hurdle rate of return in a given year, it gets added to the next one. So we're very aligned, I think, just on the fee structure there. The third one there is we don't have any hidden costs. So we're totally explicit with our investors as to what the costs of running the fund are. We cap them and we prorata them. So that essentially means the bigger you are as an investor in the fund, the more your share of those costs and expenses are. And linked to that is the incentivization of myself and my management team, of which there are 4 founding partners. And we are the second largest investor in my fund. So we are very invested, I should say, pun intended, that we keep the costs low and that we're focused on generating long-term performance. And by being the second largest investor in the fund, it allows us to invest for the long term. Most funds are very short-termist, especially if you know you're only going to be around on average for 4 years. So your investment time horizons are very short. Our minimum investment time horizon is 5 years. So when we're buying a stock, we're thinking at minimum 5 years ahead. So that strength of capital in our business gives us the opportunity to take that longer-term view. And that allows us to have less competition. So I think all of these things help to widen the moat around our fund. Because if you're an established fund, of the 10,000 funds, if you rank them on Bloomberg, I think there are probably 5 to 10 maximum that charge 0 management fee. So if you start a fund with 0 management fee, the question you ask yourself is, well, are the 9,990 other funds that charge 2% to 5% management fees going to cut it to 0 to compete with you? No. So you've already got an unassailable moat around your business because all the ones that are already there are never going to copy you. And obviously when you go and meet an investor, you can point out all these problems and say, but hold on, I've already got the solution for you. And it's a relatively easy sales pitch. Thank you for your question. In the back.
Sounds like the main issue for hedge fund managers is actually scaling the business, and something also Simmons talked about. One of the hardest things they did at Renaissance was measuring their own effects in the market when they go in and buy something or sell something or short something. So how do you scale without failing?
I think that's a really good question. Slightly more on the technical side, because Jim Simmons, for those of you who don't know, ran Renaissance Technologies, which was, in some respects, the most successful hedge fund of all time, especially in the quant world. the returns that they've generated. I think they're in excess of 30% a year for well over 30 years. The issue with his strategy is, sorry, what was your name? Andreas. As Andreas has alluded to there, the issue that he had was, there's a reason why he's not the world's wealthiest man. And the reason is that strategy does not scale. So there are certain strategies within the hedge fund industry that don't scale. So what he's doing there are very, very high frequency trading on very esoteric, making lots of very esoteric bets. And there's only a certain amount of capital that you can put to use in each of those bets during a period of time. And that's why he had to cap the size of his fund to keep the returns as high as they were. I think he'd done a lot of work working out that if he doubled the size of the fund, the returns would more than halve. So it wouldn't be worthwhile increasing the fund anymore. So to come to our strategy, essentially we want to make sure that if push came to shove that we needed to liquidate our business within a week, we want to make sure that if we were no more than 20% of the average daily traded volume of all the stocks in our portfolio, that we could liquidate them over the course of 5 days. And we can do that with our current assets under management and all the way up to $10 billion US. So the idea there is that we can scale our business over time without changing our investment strategy. Because one of the things about financial markets is the smaller and less liquid parts of the market tend to be the least efficient. So in general, if you want to make money, you go and invest in microcap companies. They're the most volatile. They're the least covered. But it's not a scalable strategy. Because if you go and look at microcap hedge funds, they're capped in terms of size. Because there's only a certain amount of money they can put into each stock idea before they move the price against themselves. So for us, we always knew that we wanted to be able to scale our fund into a reasonably sized business. So the business opportunities that we focus on, the average market capitalization for our business is roughly $7 billion. Whereas a microcap fund, for example, might cap their positions, the average size might be $100 million. So if you're managing $100 million and you've got, say, 20 positions, you're going to move the price because you're going to be more than 5% of that business. And then when it comes to buying and selling, you're going to push the price up against yourself when you're buying and then against yourself when you're selling. And that all comes out of your P&L at the end of the day. So what I would say is for a fund manager's perspective, you have to understand your niche. You have to understand what you're good at. Because if you're a very good microcap investor and you have a microcap fund, there's huge business risk to change your investment strategy to larger businesses. It's a totally different game. And there's also no guarantee for your investors that you'll be successful at that. So what you find is the biggest business risk with a hedge fund is when the manager changes their strategy. So you invest with them because they're a great microcap manager and then they say, you know what, I'm going to quadruple the size of my fund and I'm going to be a mid-cap manager. That's usually a bit of a red flag where a lot of investors will tend to leave because the manager doesn't have a proven track record in that area. Thank you.
Talking about track records, would you agree or disagree that success speaks for itself within the industry? Sort of taking into account, especially like the rule number 2 where you talked about the relationship between your investors and yourself in terms of that you sort of have to cater to your investors a lot in order to be successful?
It's a really interesting question. I think, so Warren Buffett said that you could be a fund manager in a rowing boat in the middle of the Atlantic Ocean, surrounded by sharks, and fund investors would swim towards you if your returns were better than the average, and they'd give you money. I disagree. I don't think that that's true today. I think there are too many funds doing too many different things that to differentiate yourself purely based on performance is a really hard thing to do. Because there's always a caveat to performance. Because the question is, what's your strategy? How many years have you delivered that performance for? And the issue will be, as I said during my talk, that the majority of hedge fund returns, the significant outperformance, normally happens at the start of a hedge fund journey for a manager. And that's usually where institutional investors tend not to want to invest. Because they normally have a rule that says if the fund manager hasn't been in business for at least 5 years, then actually we're not even going to look at the track record. But I've already told you the average fund lasts for only 4 years. So actually half of the people have already left the business before they're eligible for further investment. And those fund managers could have had really good performance. But there's a difference between demonstrating good performance and actually someone wanting to trust you with their own money. And those are two totally different things. So a lot of these fund managers will have had maybe better performance than myself, but they won't be able to scale the business because they can't explain their story. They can't explain their process. And people are very uncomfortable, I think, in general. I think it comes down for investors in one of two ways. I think if you want to trust somebody with your money, either you think they're a genius, Jim Simmons of Renaissance perhaps, where he says, you know what, I've got a black box strategy, it makes 30% per year, I can't explain to you and I won't explain to you how it does that, you just have to trust me. And you go, okay, I'll make that bet. Or you go the opposite end of the spectrum where the manager says, this is what we do, this is how we do it. And you go, okay, that makes sense to me. You're buying undervalued businesses and you're holding for the long term. And therefore, I'll trust you with my money. But I think if you're anywhere in between that, you're going to find it really, really difficult.
Thank you. So I have 2 questions, if that is okay. First,
Well, it depends how good the first question is.
yes. So the first one is, if I understood it correctly, you started in rates trading and in credit trading. What did you learn in this job to become a value investor?
Do you want to ask the second one and I can decide which one I like? No, I'm kidding. So I think I have a relatively unusual background for a value investor, some might say. When you look at most other, or many other value investors, they typically started in equity investing and then they stayed there. For me, I got a job trading interest rates at Morgan Stanley after having done internships at Goldman Sachs and also one at Morgan Stanley. And what I was really interested is I set myself the goal. I knew that I never wanted to work for a bank for a very long period of time. I always felt that I wanted to manage my own fund, whatever that was doing. So I gave myself a trajectory. I said I'm going to work for a maximum of 10 years for other people before I go out on my own and do my own thing. I didn't know at the time what it would be. So I thought, well, why not learn the macroeconomic side of the business first? And that's why I went into rates trading. So rates is very macro-driven. So essentially, I sat on the peripheral government bond desk at Morgan Stanley. So we were trading the debt of Portugal, Ireland, Greece, Cyprus, and Slovenia during the European sovereign debt crisis, which was obviously incredibly volatile. We also traded sovereign CDS, so credit default swaps of G10 currencies. And interestingly, it was because I was trading what arguably is a rates product, but actually everything like Greece trades on a spread relative to Germany in terms of interest rates. So actually you could argue it's a credit product. And that's why after learning sort of the macro trading side from Morgan Stanley trading rates, I moved to Credit Suisse to look at the micro side. Because there I was essentially trading the debt of banks. So I'm looking at the balance sheets, income statements, and cash flow statements of the individual banks and working out where within their capital structure we should be deploying our own capital and where we should be suggesting to our own clients where they should be deploying theirs. So I think that education essentially, I saw practically how you apply the macro and the micro to an investment case. But interestingly, from a value investing perspective, if you work at a bank, whatever product you trade, you can't invest with your personal money. So I was only able to invest in equities with my own money during my career. And I think that that's what was always my focus, because from when I was in university was essentially when I really got going with investing in equities. And then I spent my entire time when I was working through my professional career in investing in equities on the side. And I realized that the way that I was successful in making money was through long-term buy and hold of exceptional businesses that were going through a period of underperformance, where I could foresee a reason or a catalyst why that might change.
Okay, I think it's very interesting on that. So the second question I had, basically, when you open the news today, so any other day, there's so much going on in the markets. Trump is tweeting something every day, and I'm just wondering, how do you keep afloat with all the news coming in daily and managing a fund and then trying to focus on good businesses and on business analysis, but also watching all the news that are just coming up? So how do you manage basically where to put in your focus on the news or on basically, let's say, fundamental analysis?
So we are bottoms-up stock pickers. So we're looking at individual businesses all around the world. So you could say on one hand, we don't care about the macro. But I think that can also be perceived as a little bit naive, because quite often it's the macro situations that can give us the opportunities in a given market. So I could give you an example with Turkey. So Turkey was an example where I read in the news, it was actually in the Financial Times, this is 4 or 5 years ago now, but they essentially said Turkey is uninvestable because at the time Erdogan has a very unorthodox economic policy. I don't know how many of you know, but at the time he basically said that if you want to get inflation down, you decrease interest rates, which I think anyone that's looked at an economics textbook probably goes against the grain. And that was the seed of an idea. Because once I read that article, I was like, oh, that's very interesting. So let's have a look at the Turkish stock market. Because if everyone's saying it's uninvestable, that probably means that there's some opportunities there if you look closely enough. It probably means that anyone that normally looks there probably isn't looking there, so there's less competition. So I would say that you can find thematic ideas through the media. But when it comes to the daily grind of what the media produces, I think you always have to keep in the back of your mind, actually front and center I'd probably say, is that the media is there to sell newspapers, and it's to get eyeballs on news stories. So everything they say is normally quite dramatic. It's usually attention grabbing. And actually 99.9% of the time there is very little going on. And even the periods of time where there is something that seems quite dramatically going on, it might have absolutely, or most often has no bearing on what we do. So, for example, if I open the newspaper and it talks about Trump's tariffs, and I think about the implications of that on our portfolio businesses, I do, and I think about what's our exposure to China, if he increases tariffs, how will that do? But the truth of the matter is, if we own a business in China and Trump puts 20% tariffs on that business, and because of that, I think it's a bad investment idea, then clearly it was a bad investment idea to start with. Because if the business is in our portfolio, it should be an exceptional business, regardless of the macroeconomic environment. We're not investing in a business because we want it to go up a little bit. We're investing in a business because we want it to go up a lot over the long term. And that's what we project. So, in general, the short-term dislocations you might get with, for example, Trump making an announcement, the stock falling 15% or 10%, those sort of things don't bother me. It would only be if something happened that it totally changed our investment thesis. For example, if Trump said, we're going to delist all companies that have exposure to China, we're going to have an embargo on them. That's a totally different story. I think that sort of thing is probably highly unlikely, because it would be shooting himself in the foot. But I hope that kind of answers your question, because it's a very nuanced question. There's a lot of different ways to look at it.
Okay, thank you.
Thank you.
How long does it take for you to get conviction on a trade?
Well, that's a great question. There are some ideas that when you come across them, it's almost like someone's hit you over the head, because you're like, how can this not work? And then you really want to really want to engage on it quickly, and you get very excited when you start doing the research. And those ones, from my experience, are also the ones that you should then push on the decelerator, push on the brake, and take a little bit more time with. Because I would say in markets in general, the really obvious ideas have usually been discovered already. So if you think it's exceptional, like properly exceptional, it probably is worthy of a little bit more analysis just for you to figure out. So I try, when we're looking at investment ideas, we have a filter, we have essentially a checklist. So we have a pre-investment checklist of roughly 250 questions. And they are all quantitative or qualitative. So quantitative means, we're looking at what's the revenue growth, what's the margins of the business. And then on the qualitative side, we might be like, well, who's the management team? Are they good capital allocators? What is their track record? And I would say it typically takes 2 weeks to put a business through those 250 questions. And the purpose there isn't that we answer every question about the business or that every answer is a great one. It's more that if we come across a question for that business that throws up a red flag, that's worthy of more due diligence. Because typically speaking, during the course of all of your investing careers, you'll have successes and mistakes. And one of the things I'd strongly recommend is you spend a lot of time on your mistakes and trying to learn from them. So what we do is every time we sell a business, it usually means that we've made a mistake, because clearly we don't think it's going up anymore. Or it's gone down a lot and we don't think it's going to come back. So we need to spend a bit of time picking over those ideas and trying to figure out, where did we go wrong? And whatever the reasons are that we managed to identify, we should add them into our pre-investment checklist for future investments. So I'd say, typically speaking, from an idea arising to us implementing it in a portfolio could be a couple of months. And I think it links back nicely to your question before, a little bit, where I said, some people might follow that up and say, well, what happens if the stock moves in that period of time? Well, the truthful answer to that again would be, we're not buying it for a 10% return. We're buying it because we think it's going to go up hundreds of percent over the next 5, 10, 15 years. So even if the stock price moves 20% up or 20% down, if that disproves our investment thesis in any way, then actually it's not an appropriate investment for us. Thank you for your question. Sure.
What was the idea behind this reverse psychology of naming this as how not to start a successful hedge fund? Was it inspired by some of your experience, or you actually do not want to take blame if somebody is not successful?
I'll go back here to the beginning. So really, so Charlie Munger with the red tie there, he actually died in 2023. And he popularized a lot of different mental models. And a lot of his talks are available on YouTube. And I'd recommend you can listen to them there, or if you like reading, he's got a book called Poor Charlie's Almanac, where it's essentially a series of the speeches that he gives. So my talk here on telling you how not to do something is taking inspiration from him, which is a lot of his talks were about how not to do things. Because a lot of people or most people go into a room and they'll explain to you how to be successful. This is how you should do this. This is how you should do that. But actually, the way that everybody is successful is different. But so what he probably would have argued is there's no right way, but there's a lot of wrong ways. And actually learning from our mistakes, when it came back to my pre-investment checklist on our investments, or learning from the mistakes of others, and therefore how not to do something. Thinking about destination analysis, I always think is interesting. So if you're thinking about an investment, you're often thinking, well, what's going to make the stock go up? Well, you should be inverting that, thinking, what's going to make this stock go down? What could make this business fail? And then you test that thesis as to, well, why would that happen? How would that happen? What would I do if that happened? What would the business management team do if that happened? That's the theme of inversion. And I think it's thinking about things differently, because ultimately the market is the sum of everybody's opinions. And to beat the market, as we saw in the slide there, you have to have a different portfolio from the market. And therefore you have to own different things. So the truth of the matter is, if you're buying everything that everybody else already thinks is good, your returns are going to be the same as everybody else. And they might be okay, but by definition, half will be above average and half will be below. And then you have the market. So if you want to outperform, you have to have differentiated ideas. So you've got to be looking at things differently. And that's what Charlie pioneered with his thoughts on mental models, which were ways of simplifying the world, but looking at it through a different lens. And that allows you to think differently. And I think that that's true whether it comes to looking at an exam question when you're at university, or whether it comes to making an investment, or in my fund, for example, or when you're presented with an opportunity. If everybody looks at it the same way and you look at it slightly differently. One of the things I remember was when I interned at Goldman Sachs, like I said, and there were 50 of us, and we were all asked to give a stock pitch. That's all we were told. Please come, it's got to be 5 minutes long, pitch us a stock. And I had read a little bit about Munger at this time, and I thought, oh, that's interesting. I said, I wonder how I can differentiate myself from the other 50 people. I was like, I'll come up with an amazing stock. I'll find the best one. And it didn't take me very long to realize that that's an impossible task. Right? So what should I do? So I flipped it on its head and I said, you know what? They've said pitch a stock, but they didn't say buy or sell. I'm going to pitch a sell. So out of the 50 of us that pitched, I was the only one that stood up there and said, I'm going to pitch you something today that you should sell. I think this business is going to go down in value. And that stood me out from the rest. And the only thing I'd done was just think, well, how do I differentiate my view from everybody else that's going to be doing the same thing? And that's the mental model of inversion in action. Thank you.
Didn't you say that you would not be successful by not trying to beat the market? And therefore, if you would go sort of by number or large numbers, would you sort of say that by going against the majority that you would expose yourself to substantial risk?
So that's an interesting question, because I think it comes down to, do you think markets are efficient or not? So Christian, at this point, you can cover your ears. Okay. Markets are definitely not efficient.
Are we still teaching that here?
So on average, the market is the sum opinion of everybody in the room at the moment. So you look at a stock price today, and that price essentially is the sum total of everybody that owns or doesn't own that stock and what they think about it. And what our view is that's a very short-term time horizon. If you go and ask Tim Cook, the CEO of Apple, how much will Apple earn next week? He wouldn't be able to tell you the answer. And then if you ask him, well, how much will you make this month, this year, 5 years from now? He's got absolutely no clue. And he's the CEO of Apple. So what makes you as an individual investor think that you have any idea what Apple will be worth in 5 years' time? Because the value of the stock is the sum of all the future cash flows of that business. So you've got to project forward what you think Apple is going to make in the future, in this example for the next 5 years. That's what the market is doing. And it's just the average of all those guesses. It's kind of like the wisdom of crowds. But as you extrapolate out that time horizon, our estimates get worse and worse and worse. And that's where, if you're competing on investment ideas with a 1-month time horizon, it's almost a zero-sum game that you can never win. But if you're extending your time horizon to 5 years or beyond like we do, there's substantially less competition. And obviously there's way more room for our own interpretation of what we think the future will look like compared to the market. And that's where we diverge from it. And that's where we think that despite the fact that we say the future is inherently unknowable, we're able to project forward a different conclusion from the market about not all businesses, but some businesses, and see that their price today doesn't adequately reflect what we think the price should be in the future. And so that's where I would say that by taking a longer term view, as opposed to a shorter term view, you can outperform the market by having a differentiated portfolio.
Can I ask a follow-up question?
Of course.
Sort of looking more towards a substantial investment thesis. And you were telling us that you're looking, for example, at strong growth trajectory, strong management, and economic general incentives within the business, and like outstanding business ideas, sort of. Wouldn't you say that, for example, I don't know, not even for example, in general, that almost all private equity investors and in general stock picking investors do that? So where's your sort of differentiation in terms of that? And I mean that in the nicest way possible, because, for example, your presentation I found very inspiring, compelling even, and I understood what you were saying, especially within those softer aspects in terms of partnerships and stuff like that, but only focusing on an investment thesis. Wouldn't you say that there's a lot of competition even for longer term investors then?
So I'd say the further you extend your investment time horizon, the less competition you have in general. I'd say that. And I think the question, if I was to boil it down, if you don't mind me asking, is if all the great ideas are already there, what makes you think that you could find them if what you're looking for are already great businesses? So I think I gave one example briefly when I talked about Turkey. So Turkey was an example where there are many incredibly knowledgeable Turkish investors, but they work for very large institutions that essentially follow the herd, so to speak. So when the president of the country stands up and says, you know what, I believe in this unorthodox economic policy whereby I'm going to decrease interest rates and that's going to reduce inflation, a lot of these big firms essentially said, well, we don't want to invest here anymore because this place is uninvestable because it's married, it's run by someone that doesn't understand how economics works. So then all of a sudden you've got a situation where lots of smart people are forced sellers. Because they'll have, if you look at a big institution, let's say, we were talking about earlier when we came to Renaissance, different size of different funds. So Turkey is a relatively small equity market compared to, for example, to the US or anything in developed markets. So in that space where you've got a couple of $100 billion worth of equities that are liquid that you can trade in and out of, what you've got there is you've got the large institutional players retrenching, coming back, taking their money out. And the reality is we're all emotional people, fundamentally. So when you read the newspaper and it goes, Turkey's uninvestable, it's on the front page of the FT, and you have a fund manager that's invested in Turkey, I'm pretty sure most of the people call up that fund manager and go, oh, what are you doing? And then when you don't give them a good reason why they should stay, they pull their money out. So they're forced sellers. And that gives the opportunity for people like me, who are looking for fundamentally exceptional business, because there's no change in the business in Turkey. The business is still just as good as it was. Yeah, the share price might have fallen 80%, but that's nothing to do with the management team. The fundamentals of the business are exactly the same. But what you've had there is you've had forced liquidation of shareholdings due to a macroeconomic circumstance, which has no bearing whatsoever on the companies. And I can give you a really good example. And a lot of people would say, well, the thing is, if Erdogan insists on decreasing interest rates and inflation, because he thinks it will go down, and inflation goes up, that's obviously terrible for the currency, which it is. So the Turkish lira, when we first invested in Turkey sort of 4 years ago now, I think it was 1 to 4 to the dollar, and it's now 1 to 30. So massive depreciation of the currency. And a lot of investors would be very wary of that, oh, you can't invest there, big depreciation of the currency. And again, this is all ensuring that money is coming out of that market, which presents an opportunity for people like me. And then you look at some of the companies there, and I remember I visited one, we don't invest in it. They are the largest orange juice exporter in Europe, to Europe. So all of their costs are in Turkish lira. So that's labor, and that's planting trees and harvesting oranges. And they only sell them into Europe in euros. So if you think about that for a second, I've told you the currency has gone from 1 to 4 to the US dollar to 1 to 30. All of that profit goes to their bottom line. And the business is exactly the same. So that's just an example where I can find exceptional businesses all around the world. Where, and this is just one example where there's a macroeconomic shock, but there's countless different examples of that where there are underlooked gems in all of these different markets for various different reasons. And it's funds like mine going to all these sort of less established regions that therefore make the market more effective. And that's when we add value, not just to our investors, but also making the market more efficient.
So you are aiming for a market where you don't have no competition, that you're not saying that you will find like the perfect business which only you know about in the world, but you are trying to find a market where there's as little as possible competition, and then you are confident in your partnership with your investors that allow you to go in there even though it might seem risky at first glance.
So how I like to explain it is I think that risk and uncertainty are not the same thing. So, and I think that that's what the market, so markets like certainty. They want to know what your company's earnings are every quarter. And if you meet those earnings, you're generally rewarded with a flat to rising share price. If you miss your earnings, your share price will normally fall dramatically because markets like certainty. If you introduce uncertainty into the picture, markets really don't like that and they heavily discount the value of those stocks. So I describe investing as a bit like a Swiss Army knife. That example of Turkey, that's essentially an esoteric situation. That's not the norm that happens in most countries. That's just one example. So that would be an example where, yes, I think in that example, we can take advantage of other people's naivety about the market or their forced selling. And we can take advantage of that and we can buy these exceptional businesses at unbelievably cheap prices because we believe that Erdogan will eventually come around to the fact that he does need to raise interest rates at some point. And while he's not raising interest rates, the currency depreciates and our businesses are earning more money because all their costs are in lira. So that's okay. But that's just one example. Another example would be where you don't always have to have an exogenous shock. What you could be recognizing is that a management team is significantly better at capital allocation than what the market is pricing in. The market cares about what I just said, the earnings quarter to quarter. I care about what are the earnings in 5 years' time. I really don't care about what this quarter's earnings are. If you listen to a quarterly earnings call for a company, all you hear in terms of questions is, what will the earnings be next quarter? That's all they care about. I care about 5 years from now. I want to know, is this manager better or worse or as good as the market is implying in terms of capital allocation? So you look at the track record of a business and you'll see that they've started in, for example, let's say they've started in rail freight, and then they've expanded out to doing warehouses at the side of the railway lines that they operate. And you'll see they've doubled the size of the business, and you'll be like, okay, this is interesting. Clearly, the manager is quite good at capital allocation because it's not a completely separate business. He's just seen another avenue for capital where he can deploy it. And then the question would be, well, what other opportunities has he got to deploy that capital in other adjacent businesses to grow the size of his business? And the market might attribute no value to that whatsoever because the market doesn't care that he could start a new business that in 5 or 10 years' time might quadruple the size of his business. They only care what are the earnings this quarter. And that comes back to the start of my answer to your first question, which was, if you're a short-term investor, it's almost impossible to beat the market. But the further out you increase your investment time horizon, the less competition you have, and the more easy, relatively speaking, it is to outperform. Sure.
Turning that question a little bit back on you, thinking about 5 years from now as an investor in your fund, what do you see as the things that you're doing or the people that you're hiring or sort of things that you're doing to be an even better fund manager in 5 years to make your investors still as confident as they are today?
It's a very good question. I think that what we did is we spent a lot of time before we started our fund working out, as I went through in the presentation, the problems with the fund management industry. So we set up our business on the basis that we already want to be at the destination. we already want to have the right team, the right systems, the right policies, the right procedures, the right investment strategy to be able to grow and scale our business over time. So I would say, and I think that's what gives comfort to investors for a relatively newer fund manager such as ourselves, who've only been in business for just under 4 years. So hopefully we make it to the 4-year anniversary, otherwise I'm not coming back next year. Because I think that one of the key differentiators for us is the fact that we've already done that work. So I don't foresee us having to adjust very much our business at all if we were to receive a large check from an endowment tomorrow or substantially more investors or that sort of thing. I think the other thing is different people look at investing different ways. I view investing as a solo activity. Some people view it as a team sport. There are examples of both working, but I think in general investing is a solo activity because you have to define your circle of competence, which is the businesses that you know and can understand. And your circle might not overlap with somebody else's. So if you hire an analyst in, if I do that, and they come to me with a great idea every day, or what they think is a great idea, it might sit so far outside of my circle of competence, I'm going to have to just be constantly telling them no. And I don't think that's good for them, and it's not necessarily good for me, it's just a distraction. Because I know what I'm looking for when I see it, even if I find it hard to talk about what it is until I see it. So I don't think we're looking at growing our team substantially. I think the one area of focus for us would be we try to have a focus on quality over quantity in terms of the materials that we produce. And I think that as we scale our business, we will have more not necessarily more thoughts on markets, but we'll have more data to support the claims that we're making about markets. So I'd hope that some of our research pieces would become much more widely distributed than they are currently. That's what I'd say. Thank you. Sure.
How does ESG impact your, just in terms of investing and decision making, global yes list?
So I should have Christian answer that.
You're the boss man.
So ESG is really important. But as Christian has told me many times, it's just in the wrong order. It should start with the G. So for us, it's impossible to understand why anyone would invest in any business if it didn't have good corporate governance. It's just, that's a fact. So whenever anyone in the US talks about the fact that ESG is nonsense, they're talking about the wrong part of the ES and the G. Because no one would give money to somebody that they didn't think could run the business. That's a fact. So good corporate governance is incredibly important for us. When it comes to the other two factors, so sort of social responsibility, how they work within the environments they work in, if you're a long-term investor like us, well, we do care. Because if you are depleting the earth of raw materials, I mean, mining is an interesting one, right? Because you would say, there's a lot of talk in the value investing community at the moment about investing in coal. So we will need metallurgical coal for the foreseeable future to power blast furnaces to make steel, because there is essentially no other way of economically making steel. Coal companies can't raise financing from banks because the banks don't want to put on their reports that they're no longer meeting any of the ESG criteria because they're lending to coal miners. So you'd say, okay, so they're really depressed prices for coal mining companies. It seems like a relatively attractive value proposition. The issue is that what I find with those extractive industries when it comes to ESG is the fact that for every pound of coal that they take out of the ground, they need to find another pound of coal to replace it with. Otherwise, fundamentally, they're eventually going to run out of coal. So that's not a sustainable business model, in my view, because you're extracting from the earth and you need to constantly find new places. It's one of the reasons why we don't have any oil and gas companies in our portfolio. Because it's all well and good that Exxon makes X $100 billion a year in extractive oil and natural gas, but they need to find new reserves to replace that with constantly. And the truth of the matter is, if the price of those is going up, they're paying more for the new ones, or the same as what they're paying for the old ones. So I think the E and the S are still incredibly important. And how do we think about it? We also think about it from our investors' perspective. A lot of our investors are high net worth individuals or family offices. And in general, they therefore tend to be in their 60s or older. And they've made their money, you might argue. And not only do they want to invest to make more money, but they also want to do it in the right way. They want to make the world a better place while doing it, if you can. So ESG is a key part of our investment process. So Christian actually runs that element of our screening process. So it doesn't mean that we won't invest in a business that doesn't score highly. There's actually lots of reasons why a business wouldn't score highly. We've got a good example of a company in Japan that we've worked with where they scored very poorly on a lot of the ESG criteria. But interestingly, they're an incredibly ESG compliant business. The issue was they hadn't translated their documents into the right format to be received on the platforms where you supply the data to. So I think there's a lot of nuances to sort of how to invest in ESG. But yes, it's a key part of our investment strategy.
What do you think of those, I'm going to call them conglomerate hedge funds? So, for example, Berkshire Hathaway, you could argue they're collecting insurance premium and then investing that money. Also, you have Bill Ackman trying to build a modern Berkshire Hathaway. What's your take on that? Do you see your fund going that way, or is that something completely different?
So I think that the difference between us and those two examples is the fact that they're using a publicly listed company to do those things, whereas we as a private company, we invest in publicly listed businesses, so slightly different. But Bill Ackman does run a hedge fund separate, which is called Pershing Square. And he is trying to make what he calls a baby Berkshire Hathaway, and I wish him the very, very best of luck with doing that. What Buffett does is quite unique, whereby the insurance industry is a commodity product. And the truth is, I don't know, I presume most people here, if you have a car, you've got car insurance. If you've gone on a holiday, you bought travel insurance. And I'm pretty sure you didn't spend very much time looking other than looking at what was the lowest price. Probably didn't read the terms and conditions. You just go for the lowest price. It's a commodity product. Therefore, it's not a very good business. Because by definition, the only way to be good in that business is scale. You need to be the biggest. And essentially what Warren Buffett does is he owns one of the largest, or a few of the largest insurers and reinsurers businesses in the US and globally. And essentially what happens when you buy insurance is you pay for the insurance, and then if you make a claim, they pay you back. But in the interim, they get that money that you've given them, which is called insurance float, and they invest that money. And that's essentially what Buffett has done. And it's interesting because it's essentially leverage for Berkshire Hathaway, because it allows them to take borrowed capital and invest it in the stock market. That's essentially what it does. And then the returns that accrue to that are all profit to the bottom line, provided that they pay out less in claims in the future than they've taken in, so their underwriting standards are very high. I think it's an incredibly clever business model, but I think Bill Ackman will have a very hard time replicating what Berkshire Hathaway has built over 60 years, because the scale required to compete in those industries is very, very significant. Sure.
I'm just curious about how long did it take you for get a proven track record of your investment strategy before you were able to attract outside investors?
Very interesting question. So when I was working at the family office for 4 years, I essentially came about to this investment strategy, which is essentially where we have a concentrated portfolio of 20 to 30 businesses. Half of them are in developed markets and half of them are in emerging markets. And the reason for that is that over a short period of time, less than 5 years, developed markets and emerging market returns tend not to be very correlated. So you can have the US that's doing really well, and you might have Turkey that's doing really badly, and vice versa. There's not an enormous amount of correlation. But over time, if you extend that out to 5, 10 years, the correlation is very high. Markets tend to go up together. So in terms of developing the investment strategy, it was during those 4 years. And I had some friends and family who I used to give advice to in terms of I would tell them what I was doing in my personal portfolio. And they would essentially copy some of those trades. And one of the family offices that I gave some advice to basically said to me, well, these seem to be working quite well. The issue is we don't get to talk to you all the time. So you tell us that you've bought something, but we don't know whether you sold it, whether you've kept it. So they said, why didn't you come and work for us? And I said, well, I actually, no, is the answer, because I want to run my own fund and I want to work for myself. So they essentially said to me, okay, well, we will provide you some capital then when you start out. And then, interestingly, when we started in 2022, that was a bear market in the stock market that year. That's where the markets were down roughly 20% by July of that year of 2022. We started in November of 2022. And interestingly, when we started, the investor that said that they give us money actually said, oh, we can't actually now. Markets are a bit volatile. We've got a few issues with our family business. So myself and my team, we said, well, we're concentrated contrarian value investors. This is the best time to be buying equities when the market is down. So we launched our fund just with our own capital. We took the business risk that if we bought now at that time, we didn't know how much further down the market might go. We didn't know how long it would take to recover, but we knew we were buying exceptional businesses at really cheap prices. So we thought, well, if we're not willing to do it today with our own money, then why should we wait for an investor to give us theirs to buy at a less opportune time? Let's start our track record just with our own capital. And we ran just our own capital for almost a year before our original investor came back to us and said, "Oh, you guys have made almost 20%. Well, I haven't invested. I'm a bit behind the curve, so here's a check." And then what we've done is we've never let them forget that, so they have to keep giving us more money over time. Thank you. Yes?
So how do you know a stock is undervalued or it's just a value trap?
That's a very good question. Value traps, I think, are almost only obvious in hindsight. Because you can look like a genius if you buy shares in a business that's done nothing for a very long period of time, but you've recognized something is changing about that business and all of a sudden it takes off. And previously, for the previous 10 years, that might have been a value trap. And you can have an example of that with an entire market. So if you look at Japan, Japanese equities did nothing for almost 20 years. And you could argue that entire market during that period of time was a value trap. Of course, there were equities within that market that did incredibly well during that period of time. You just needed to be able to find them. I think the key thing for us when we're looking at a business and the key differentiator is the management team. You need good capital allocation skills from a management team to grow a business. Fact. You can buy undervalued businesses, like cigar butt businesses that don't have good management teams, that just crank out earnings, that are significantly underpriced by the market, and you can make money by doing that. But the real money tends to be made, as Buffett has shown as his investment strategy changed over time, is from buying businesses that become or are in the process of becoming exceptional. And they do that through growth. So I would say one of the typical things to be looking for between a value trap and anything else is you need to see a bit of growth. And I think a lot of investors get too focused on what looks optically very cheap. But if there's no catalyst, if there's no reason for change, you could own that business for 10 years or 20 years and there might be no change. And also, you can also be wrong. You know, there actually might be a lot less value in it than you think. And what I find is a business with even a little bit of growth can tend to, it significantly reduces the probability of permanent loss of capital, which is essentially what I call risk. The chance that I put $100 into a business and it goes to zero. If that business is growing even slightly, I can be wrong on my investment thesis and I might still be okay before I exit. Versus a business that might be trading a lot cheaper but with no growth. Those businesses you have to be very, very careful with, because if that growth turns negative, that value trap can very, very quickly totally disappear. Thank you.
Can I also ask you a private question?
You can indeed. We're a little bit over, so sorry if anybody needed to go, that's no problem at all. But I'm very happy to hang around until you're done with questions.
In terms of your own career and everything that you've seen so far, where you worked and experiences you made, if you're looking back now, I mean, we of course sitting here as university students, we see a hedge fund manager who sounds extremely successful and maybe wants to be in your shoes or in your position one day. If you're looking back on your career, would you do everything again like you did and how you wrote it down on the slide, or would you do something different? And maybe also, what if you could give all of us a piece of advice, what would it be?
That is a question that I've heard different variations of, asked in lots of different people. And I've also asked variations of that question to people that I thought I admired or were successful. And I usually got the answer that was, oh, follow your passions. And I don't think that that's true. Because I think you have to think very carefully about what you want in life. If your passion is painting, and therefore you're going to be an artist, that's what you want to do, you just have to be very aware of the fact of the positive and negative associations with making that decision. If you look at all the most successful artists, Rene Magritte was an example there I gave you, the paintings were only really worth anything after they died. So the chances of you living in a really nice home with a really stable income are probably quite low. On the flip side of that, if your passion is investing, the positive externality of that is if you're good at it, you will probably make a lot of money. And it's one of the questions that was posed to Warren Buffett, and he essentially said, he was like, if I was born in a different place, in a different era, I would be totally useless, because the only thing I'm good at is reading income statements, balance sheets, and cash flow statements, and buying cheap businesses, and them going up in value. That is very highly rewarded in our society today, but it wouldn't have been rewarded in society 200 years ago. So my advice for you is to think very carefully with the decisions that you make. When someone says simply follow your passions, I think it's a really simplistic answer, because it's a really complex question. What should you do? How should you spend your time? What do you want out of life? They're really big questions. And I wouldn't put too much pressure on yourself to answer them either. I'd say life is about the journey. It's not about the destination. And I'd say try things. That's the great thing about being in university, which I wish I'd known more about at the time. That it's all about the journey. It's about trying things and failing at them. That's even better. If you try something and you're not good at it, but it's piqued your interest, so you want to try again, that's a really good sign that that might be a road you should follow. If you try something, you fail, and you don't care about it the next day, then clearly you weren't very passionate about it and you didn't want to follow it. So I think each of us are on our own individual journey, and you have to think very carefully about what it is that you want. But I'd encourage you to follow your curiosity instead. What makes you interested? When you get up in the morning, what is it that you like to do? When you read a newspaper, what part of the newspaper interests you? Those are the smaller questions that I ask you to ask yourself, have a look inside and be like, but what is it about that that's interesting to me? And those are the things that I'd say focus a little bit more time, effort, and energy on. Thank you. Perfect. Well, I think we'll end there then. Thank you everybody for your time.